If you own a stock portfolio, you will not want to miss this video. Let's go deep on securities financing for real estate deals. So how the 6 gap funded tool stacks over the 5 tool stack to close deals without selling your stock. Let's get fair up it. So the problem is real estate investors sitting on a stock position typically see only 2 options: sell the stock and trigger a taxable event while losing all future upside, or leave it untouched and go find capital somewhere else. Conventional lending was never built for this situation. Personal loans require monthly payments and a personal guarantee. Margin loans were not designed for restricted stock. There is a gap between the capital you hold and the capital you can deploy, and the standard toolkit doesn't bridge it. Sell the stock triggers a taxable event and forfeits all future upside on the position. Leave it sitting, capital stays locked while you scramble to find funding elsewhere. Conventional lending, personal loans, and margin loans were never designed for this use case. Here's the 5 tool stack, full recap, and how tool 6 layers over the top. So the gap funded stack sequences 5 credit based tools in a specific order. Apply out of order and you risk knocking out a later approval. So debt consolidation, typically 10 to 100K, drops utilization, boosts that FICO score fast, and it's the fastest level we can pull to put ourselves in the best position for better rates and terms on everything else, which is why it goes first. Rapid gap funding, 0% credit card stacking, PLOCs and business lines of credit. That's the sequence so far. Here's the key. Enter tool 6. Securities financing. The only tool in the stack with no FICO or credit score requirement. Underwriting is on the security, not on you. Borrow against stock or crypto. Leverage publicly traded stock or select crypto holdings without triggering a sale event. Shares stay in your name. No sale required. Your position remains intact and continues to grow. No FICO required. Here's the key. Underwriting is based entirely on the security itself, not your credit profile, which is why it layers over the top so beautifully. Now, tool 6, here's the numbers. Securities financing offers institutional scale capital with flexible terms designed for serious investors. 75% max LTV on unrestricted shares, restricted or insider stock, 30 to 50% LTV, 500 million plus max loan size. Loans range from 50K up to 500 million, scaling with your position. You know, people like Elon Musk, they've never pulled they pay themselves 50 grand a year because this is what they're leveraging. Now, 7% max annual rate, rates from 1.5 to 7% annually, interest only, paid quarterly, 10-year terms, 3, 5, 7 or 10-year terms, early repayment available after 2 years. Now, how it works. Shares are pledged into regulated custody under a control agreement with institutional custodians, including BNY, JP Morgan, Citibank, State Street, and Fidelity. The lender then advances cash against the collateral value. The pledged shares, lender advances, repay and reclaim. The structure is non-recourse. The lender's only remedy is the pledged shares. Dividends typically reduce the loan balance, and voting rights are maintained via proxy throughout the loan term. Why it stacks differently? Here's the key. Tools 1 to 5, sequenced and credit-based, can knock each other out if applied out of order, compete for the same lender approvals tied to credit profile and real property. Tool 6 comes in hardcore on the back end, collateralized against securities, not credit, runs in parallel with any of Tool 1s to 5, does not compete with the same lender approvals, no FICO, no real property required, no business revenue required. Now, because Tool 6 operates on an entirely different underwriting basis, it doesn't interfere with the credit-based stack. It expands total capacity. It expands total capital capacity rather than competing within it. Now, real deal walkthrough. An investor holds 600K public stock position and is working a fix and flip that needs a down payment and rehab capital. So you go and do your unsecured stack, runs concurrently to preserve liquidity. Your debt consolidation clears utilization. You go and do your securities financing, LTV on 600K, unlocks 180K, And then you got your gap funding for the rehab, rapid credit stacking funds, rehab budget. So who this fits and who it doesn't. A good fit, accredited investors holding a meaningful stock or crypto position, company insiders holding restricted stock who cannot sell on the open market, minimum daily trading value of 30K plus required, which is price times 60-day average volume, clear or disclosed ownership required. Now, you're not a fit if you're illiquid, thinly traded or non-public holdings, anyone unwilling to place shares into custody for the loan term, investors with no equity position outside real estate, tools 1 to 5 remain the primary stack. Now, full stack at a glance: tool 1, debt consolidation; tool 2, rapid gap funding; tool 3, credit card stacking; tool 4, HELOCs; tool 5 is your business line of credit. Now you got the tool 6, securities financing, to layer over the top and keep pumping. Here's the next step. See what your stock or crypto position could actually unlock. No sale required, no FICO check, and funding in as little as 5 to 10 business days. Apply at gapfunded.com/apply. And if you absolutely adored this video, smack that subscribe and flog the bell, and I'll see you on the next one.